Hey, what's up, everybody? It's Evan from Stock Market News here, and I got the chance recently to interview Dan Niles. We talked about a lot, everything from Apple to Nvidia to Meta and AI, and so much more. This was a really great conversation. I know each and every single one of you are going to take a lot of value from this, so make sure you listen to the entire thing. If you do enjoy the video, make sure you are subscribed to the channel so you can get a bunch more videos just like this, and hit that bell button so you can get notified when those videos get posted. And for the live streams I'm doing, which by the way, I've been doing a lot of live streams here on YouTube. So with that, let's get right into the video. I hope you all enjoy. Dan Niles was a tech investor who was green in that 2020 bloodbath. I love hearing some of his thoughts, even though sometimes you say some bad things about my largest holding, but I let it go. I let it go. I read some stuff that got going on that there might be some good words coming about my name. It's Apple, by the way, but we'll talk about that going on. But I know you've been on here before, but I would love if you could give us a little bit of an intro about just yourself and all that good stuff as we get started.
Yeah, I mean, my name is Dan Niles, as Evan said, engineer by training, master's degree in double E, microprocessor designer at Digital Equipment Corporation. But I started on Wall Street in 1990, 4 years as an investment banker, 10 years as a sell side analyst, and then the last 20 running money. And I started my own firm called Niles Investment Management on April 1st. And
Oh,
that's
congratulations.
that's kind of it. So got control of my own pretty much everything at this point. So
Oh,
anyway,
send me over the link or pin it up in the nest above. You had to know how to do that. I'd love to
I
get
have
people to
I
go do
have
that.
no idea how to do that, but it's called Niles Investment Management. So you guys can look it up if you want. So
I'll get that up
anyway,
there.
yeah.
But awesome. I was reading some of the. I always read what you write, and I read what you sent me over the other day. And I want to start it with kind of two level setting things.
Hmm.
I was reading your thing, and there was kind of two things underpinning in it. It was first of all Jerome Powell and the Fed. The fact that the markets have started to kind of absorb in higher for longer. I would love to get your kind of baseline expectations for that as you do your research into the mega cap tech names of where you think Jerome Powell and the Fed are at right now, if it's going to be no cuts this year, anything like that. And then the other big thing I noticed underpinning a lot of the stuff I was reading was AI and kind of the AI haves and have nots, specifically in mega cap tech, and how that is really important for a lot of your long term thesis there. So I would like to kind of level set and start here and just get your like baseline expectations for the Fed and for AI.
Yeah. So I don't spend a whole lot of time, honestly, worrying about the Fed. I It matters in the sense that if you go back to 2022, when you had the fastest, rate hikes in history, the market struggled because you switched from this idiotic transitory, you know, view, which I never believed in, to, oh my God, this is real and it's going to be a problem. And so every stock got crushed regardless. And then you switch to 2023 and it was the exact opposite, where you went from the fastest rate hikes in history to a Fed on hold. And then at one point you thought there were going to be 7 rate cuts coming this year. So then everything went up and it didn't matter if numbers were coming down either. So for example, Apple was up over 40%, but December quarter EPS came down 10% over the course of the year. Stock was still up. Or take Tesla, where estimates came down 50% in 2023 and the stock went up 100%. So the Fed matters, obviously, but within that framework. But now you've got sort of a Fed on hold, not doing anything. And, whether you get no rate cuts or, rate hike or rate, rates go down one, I think you're sort of in this, one plus or minus kind of for the Fed. Um, but for me, like, I have very concentrated positions that I take, and a lot of that's related to fundamentals. And so that's kind of what I count on to get me through. But to your question directly, my guess is we get, one at most in terms of rate cuts, because I do think the economy looks pretty strong. and I do think inflation is higher than what we think it's going to be. And so in that environment, you're talking none to one, most likely, is my guess. And there's enough deflation, maybe you could say, being imported, because don't forget, like, we're doing well, but Europe GDP's at 0%, and China is sort of, who knows with the official figures, but it hasn't been the greatest for most of our companies. So I think that kind of keeps inflation from getting too out of control. And energy prices have gone from being up 20% year to date to up 10. And that's the thing I probably watch the most. Then to your second thing on AI, to me, the analogy I would draw to make it very simple is to the internet, which is if you say Netscape Navigator, which was the first mass internet browser, showed up at the end of 1994, and Cisco was kind of the Nvidia of its day, right? Cisco became the most valuable company on the planet by 2000. Nvidia is at number 3 right now. And Cisco, from the quarter before we heard about this thing called the internet to the peak in 2001, their revenues went up 16x, 15 and a half, I guess, to be exact, from the quarter before to ultimately where it ended up. Now, if you look at Nvidia and you say, well, ChatGPT really started this thing called, generative AI and all the stuff that we're focused on, then you can look at Nvidia's revenues and go, well, that went from 4 billion to 24 billion in this quarter that they're supposed to report. So that's up 6x. Well, up 6x is not up 16x, which is kind of where Cisco ended up. And the companies that are spending on generative AI are the biggest, most profitable in the world. So it's, Microsoft and Google and Amazon and, Meta. Back in the internet days, you may remember a lot of the companies that were spending a lot of money were these companies you never heard of that were borrowing money, that were burning tons of cash flow. And so their ability to spend was really driven a lot by capital markets versus any cash flow that they were producing themselves. So I view generative AI as the most transformative thing we've seen since the internet or the smartphone, whatever you want to call it. And so I think we're still very early from a time perspective. It's only 15 months versus 5 years, for the internet build out before that bubble broke. And the amount you spent so far, if you use Cisco versus Nvidia as an example, is not even equivalent. And the final piece is, Cisco at one point was trading at, 135 times earnings, and Nvidia right now, if you look at, calendar 24, is trading at 40 times. So it's not even similar from a multiple point of view. So that's kind of how I think of where we kind of are. Now, that's not to say that Nvidia can't go down, 30% very easily in this, while you're going through this, because if you go and look at a Cisco chart, you'll see that the stock went down 26% in late 1995, and I think it was 38% in 97 and 34% in 1998. So you can tell I've spent a lot of time thinking about this, which means that, it wouldn't surprise me to see Nvidia do the same thing. But the stock was up 4,003% from the end of 94 to its peak in 2001. So Nvidia is up over 400% from the end of 2022 to today, but up 400 plus percent is not up 4,000% either. So anyway, that hopefully gives some perspective on it.
No, that was really great. I appreciate starting this out there. And before I let some other people get in and get in with their questions, I need to make sure we get my largest holding talked about, which is Apple, which I know generally you are not so bullish on. I always love hearing really smart people talking about the opposite side of my stock, so I'm excited. I know generally it's been the right call to be not bullish on it, at least so far this year for sure. And I know we have a pretty major Apple event coming up, WWDC in June. So I would love to hear your thoughts about kind of Apple going up into that event and maybe coming after it. I know they've kind of been considered of behind on AI, but from the maybe it's copium, maybe it's whatever. But from my perspective, Apple has built the reputation of a company that will underhype and then actually deliver a great product. They're not going to release a chatbot, call it Gemini, let's say, and then it has all the problems first day, and it's a big embarrassment. So let's hope Apple doesn't make a mistake when they first release it. But I would love to hear your thoughts on Apple and kind of any updates for in the short term up until that WWDC event, and then more of the longer term. How you view it?
Yeah. So the short term, so I'm a big believer in stacking the odds in my favor when I invest. And so if I look at Apple, um, you know, I like it quite a bit right now because of the statistics of them going into an event. And so if you look at Vision Pro as an example, I think most rational people viewed that as this is going to be a huge flop because they're trying to sell a $3,000 to $4,000 ASP product in this market to consumers. And we've already had Google Glass, Snapchat spectacles. So there's no way this is going to do well, or at least that was my view going into it. And I think what we've seen is, as Apple said on their call, they're pivoting, which is another term for it didn't work the way we thought, to the enterprise. Now, having said that, the stock went up 9% in 1 month before that event, outperforming the S&P. So I would argue with a product that people should have known was a flop, it ran up anyway. And by the way, that's what it does before all of its product announcements, or I shouldn't say all, but it has a high propensity to beat the market as well as go up before product announcements. So if you know that, they have an AI event coming on June 10th. We're almost within that window right now. Everybody is praying, who owns this thing, that this will somehow reinvigorate growth. And maybe it will, and maybe it won't. I'm more in the camp of it won't, and we'll get into that in a second. But in the near term, it really doesn't matter because there's enough people that want to desperately believe that this will fix their problems that I think the stock will outperform to get there. Now, everybody's entitled to their opinion, but you're not entitled to your own facts. So here are the facts. If you look at Apple, their revenue in the March quarter was down 4% year over year compared to March quarter of last year. The Mag 7, the Magnificent 7, on average, their revenues were up 42%. Apple's the second worst stock within that group. Only Tesla's worse at down 9. If you say, well, yeah, but that's cherry picking. It's only 1 year. Like, let's look at a longer period of time. Okay, let's pick 3 years. Over the 3-year period, March of this year, 24, to March of 21, Apple's revenues are up a whopping 1%. The Magnificent 7 revenues are up 86%. Even if you take Nvidia out, it's up 45 on average. So if you say, well, yeah, that's still too long term, let's go all the way out to 5 years. Okay, so that covers COVID, the quarter before COVID, March of 19, March quarter of 2019 to today. So Apple's revenues are up a respectable 56%. You compare that, though, with the Magnificent 7, their revenues on average are up 275%. The worst company beside Apple is Microsoft, where their revenues are up 102%. And even if you take Nvidia out, the rest of the Mag 7, including Apple, are up 155 on average, so triple what Apple's up. So I understand why somebody who's long Apple wants to desperately believe that AI will fix the issues, and maybe it will, maybe it won't. For right now, I'm in the same camp with everybody who wants to believe this will fix the problems. But my view is very different, which is Apple's got an issue with competition, which isn't going away. Because Huawei, which we cut off from chips in 2019, came out. And by the way, Huawei at the time was the second biggest smartphone vendor in the world, competing with Samsung for the #1 title back in 2019 in terms of units. Then their market share dropped to single digits. And then this year, they came surging back. They launched a new smartphone in September, I think, of 2023. And they've been picking up a ton of share. And that's what Apple's problems are coming from, is that, plus they're behind. A lot of the Android ecosystem has AI capabilities already. And foldable phones as a category have fixed some of the screen crease issues, etc., which is pretty popular in Asia. And so Apple's behind on that as well. So getting AI on the phones will just get them caught up to what a lot of the other Android vendors already have, which obviously Android's Google's product. And, that's part of the issues right now. And none of this would matter if Apple had a low PE, and so you're getting paid to take the risk. But the problem is Apple trades at a 27 PE. The S&P trades at 21 times. And as we just went through with the growth profile, the facts are, you may believe Apple's a growth company, but the facts tell you it is woefully underperformed most of the other mega cap tech peers. The reason the stock's done well is the multiples just kept expanding because people, everybody has an iPhone in their pocket. They have tons of share in the United States, and people just want to believe, and they will right up until they don't. Now, maybe this fixes the issue. I mean, it's possible that AI forces a big upgrade cycle because a lot of us, upgraded during the COVID years. But those are the facts for the last 5 years, and thankfully the multiples expanded to bail you out. I find it interesting that Warren Buffett's selling, and we could say that's risk management or something else or tax reasons, which is one of the things he brought up. But at the end of the day, he is still selling. So we'll see how this works out. But in the near term, I'm on board with all the bulls that think this AI stuff is going to be a big deal, and then we'll see how the numbers go. So maybe this is the turn. I mean, there were some numbers out of China this morning that showed that Apple's revenues in the month of March actually did well and were dramatically better than they were in January and February. So maybe after multiple years, arguably 3 years of problems, maybe we finally turned the corner. So you got to stay flexible when you're investing, and that's what we're trying to do right now. So that's the short term versus long term for Apple.
Dan, on Apple, what do you think about the share buybacks? 90 billion a year over the past couple of years in terms of announcements, 110 billion. It's essentially they're going free cash flow flat, which means that they're probably going to have to borrow, given a lot of their cash is overseas. And on your math, 27 PE, you inverse that, it's like a 3.5% earnings yield versus where they can borrow. It doesn't seem very accretive unless they think they're growing double digits going forward. Do you think that the buyback is compensating for some of the slower growth numbers that we've been getting? And does it make sense for them to buy back stock at close to a 33 PE?
Well, the thing you have to ask yourself is, I look at it slightly differently because everybody's like, oh, Apple's a great tech company. I go, no, they're not. They don't spend nearly as much as a lot of their competitors, which is why they're always behind. So if you look at CapEx to revenues, they're at 3%. Amazon's at 9, Google's at 12, Microsoft's at 17, Meta's at 19. If you say, well, what about R&D? Apple's at 8% of their revenues is in R&D. Amazon's at 14, so is Google. Microsoft's at 12, and Meta's at 26. So these guys are always behind, and that's why they're talking about, partnering with Google or partnering with OpenAI for AI on their chips. And to your point, I think they could take that money that they're spending on buybacks and really increase their R&D or CapEx to not be behind. But they're doing buybacks instead, and that's to your to kind of what you kind of alluded to there. That's, well, we can create earnings per share growth if we go ahead and buy back shares and try to control it that way. But, it's a game that eventually runs out of gas at some point. And so, we'll see how that comes out. But I go, you really can't find anything better to do with your cash than to buy back your own stock, like investing more in technology. That also bothers me when I do those ratios and compare Apple and how much they're spending compared to their peers, and what they're spending to advance technology. So the buyback in a weird way bothers me that they are spending
It
so
does.
much.
I
Yeah.
100% agree with you, and I thought that was described quantitatively and very well. I mean, if these guys are underspending everyone else by 50% on R&D and CapEx, how are they going to catch up when it comes to AI?
Well, that's the thing. That's otherwise they wouldn't have to work with Google or OpenAI. So they've kind of proven that themselves. And so, I mean, the great thing about a name like Apple is we all probably were on this call have an iPhone, right? And so it gives you some comfort because you have something sitting in your hand, and so it makes you feel better about the stock. But I laid out the facts on revenue growth over the last 5 years, 3 years, 1 year. So I laid out the facts on CapEx to revenue, the facts on R&D to revenue. And you can have your own opinion on they'll be great anyway, even with the multiple that they're at, which is a premium, by the way. At 27 times for no growth, you can get Microsoft at 33 or Meta at 23 PE, or even Nvidia is growing revenues at 100% at a 39 PE, or the market. You could buy the S&P at 21 times. But, you know, in the short term, and that can be a year or so, like nobody cares about facts. It's all about how you feel and opinions. And right now, the thing is AI is the deal. And if Apple can get, you know, their 2 billion subscribers to upgrade, then that's going to be huge. So we'll see what happens. In the near term, the good news is I'm kind of aligned with those people who are bullish on Apple on a longer term basis.
Dan.
Dan, I'm glad that you stepped in there and talked a little bit about Apple. I've been trying to tell Evan a lot of that stuff for quite some time, so I'm glad you heard it from you. And
yeah, but don't forget, right? The goal is to make money. So if Evan, if we make money on it, like who cares what the facts are? Because in the near term, it's not going to matter. And so I always tell people, do you want to be right, or do you want to make money? I want to make money.
Yeah, I agree. I agree.
Stock
So
Talk.
let's transition this a little
really
bit.
quickly before we do. Last question, and over to Stock Talk. It kind of sounds like you think Apple has a culture problem, and I've heard a lot of people talking on here that they think it's time for Tim Cook to move on as Apple CEO. Do you think that's true, or do you think it's just kind of where their product cycle is at right now?
Well, here's the thing. I mean, you can either be a leader or a follower, and people always like to say Apple may not be first, but they do it best. And you know, what I would say is that when it comes to smartphones, they have fallen behind a lot of their Android competitors. And when you're running 40-something% gross margins, right, which to me, I look at gross margins as an indication of how much value are you adding. And then you compare it against the gross margins being run at an Nvidia or Google or Microsoft, where, you know, you're running numbers 60 to 80%. And then you go, okay, so despite having low gross margins, you're also the way you've managed to manufacture your EPS with very little revenue growth is you scrimp on your R&D, you're scrimping on your CapEx, so your depreciation is low, so you can keep your margins at a pretty good pace. You know, that's fine if it's a consumer staples, low growth stock, but that's not the way it's valued. So I guess it depends on what you want the company to be in the future, because an AT&T and Verizon trade at a very different multiple than an Apple does. And you know, people say, well, you'll never give up your iPhone. Yeah, but you'll never give up the service that you're using for your iPhone to actually work either. So to me, there's a real dichotomy there, and these things will take years to ever sort themselves out. So with the Tim Cook question, I mean, if you're an Apple bull, you can just look at the stock and go, the multiples expanded. They probably they've done the best job of repositioning themselves and convincing people that they are a leader in technology and a growth company, when if you look at the actual facts, they're really not. And so you have to give them a lot of credit for the multiple expansion and the capital allocation, the buybacks, the dividend, all of that happened, you know, under Tim Cook. And, you know, kudos to them and what a great job they've done in terms of, you know, all of that financial engineering and multiple expansion and
well, it was
the
Icon
perception around it.
in 2013. I mean, when I was long Apple, it was, if it wasn't for Icon coming in and changing the way they think, like I think their buybacks may have either started a lot later, or the composition of their capital allocation would have been completely different.
Well, they've also done a great job with the government. I mean, Tim Cook, like, whether it was Donald Trump as president or President Biden, like, he was one of the first CEOs, if not the first, to meet with President Trump. So, like, he's more than happy to put his personal feelings aside, whatever they may be, for the good of the company. And so you have to give him tons of credit for that. And every CEO has its pluses and minuses. But in terms of managing a really, you know, very different political landscape during this whole tenure, I mean, he's done an amazing job. So there's a lot of kudos too you have to give him as well in terms of navigating this.
Awesome context there on Apple. Okay, Dan, we're going to transition a little bit into another category that I know a lot of people are interested in, and has certainly been a focus in the markets, which is semiconductors. Now, obviously, last year in the wake of the Chat GPT era, if you will, most of the focus was on Nvidia and the sales of GPUs, and there remains a lot of focus in that category. But as we've seen, especially in the Q1 of this year, people are starting to speculate on where else that pricing power may move in the industry. Because as we all know, GPUs aren't the only component necessary to enable this AI race. And so, kind of similarly to how we saw Micron, for example, in Q1 post, not only a solid guide, but a really solid beat on the quarter. The stock was up about 20%. Um, there are a number of other names in the industry that could be beneficiaries downstream of supply shortages and all of these different hardware components and semiconductors. So the first question being, what names are on your radar as potential beneficiaries that may not have seen the type of favor that Nvidia, and SMCI and Dell and these names have seen? And also, what do you think is preventing that from happening, if anything, going forward? So just your general thoughts on semiconductors here. Obviously, SMH up 28% year to date, but the pullbacks recently on these names, especially the intraday pullbacks, have gotten a little aggressive. So curious to hear your thoughts in general on semiconductors here and any names you might be looking at specifically.
Well, this is a question I would ask you guys. How many semiconductor companies outside of Nvidia have actually had their forward estimates go up over the last year?
Not many, but a couple. I mean,
No,
Micron.
Micron was
no. Well, if
insane.
you go back a year ago, right? Micron got the negative.
Oh, a year
Yeah,
ago.
I'm
Yeah,
saying over
yeah,
the last year since this whole ChatGPT thing started. So the point I guess I'm trying to make is that for a lot of companies, and by the way, it's not just them. I mean, if you kind of look at, well, the guys that reported, right? Google's revenues for the next quarter edged down a little bit after they reported in March. Meta guided below the street formally for June when they reported in March. Microsoft guided formally below the street when they reported revenues for March, right? Funnily enough, Apple's the only one that really kind of held. And obviously, I'm excluding Nvidia from this. But the point I'm trying to make is if you look at AMD, right, they guided below the street when they reported for December for their March quarter. Then when they reported March, the numbers really didn't, I think they guided slightly below for June. Because the point is that for these semiconductor companies, their AI business is booming. But for pretty much everybody other than Nvidia, the other businesses have gone down enough to offset the stuff that's going up. So, like, you're not going to like this answer, but it's the one I'm going to give you, which is I go, is Nvidia expensive? No. It's at 39 times. There's actually a whole bunch of semiconductor companies that are more expensive than they are. And I'm talking GAAP EPS, by the way. So just to be clear. So I look at that and I go, well, has their revenues gone up as much as I think they're going to before this is said and done? No, because the revenues are up 6x over 5 quarters, where Cisco's were up 16x, 15.5x over 5 years. And I've got a much better customer base spending with them. So I'm kind of looking at this, and you guys started off talking about ARM, and the reason it's down obviously is the full year guidance. When you look at the revenues, you kind of go, okay, well, for the full year, ARM, is guiding revenues to 3.95 billion for March of 2025, and consensus is at 3.98. So technically, it's a little bit of a miss for the fiscal year. They have AI, but they also have a humongous smartphone business, which I would guess is why you have that disconnect. So for me, I go, are you an unhappy person if you owned Amazon and didn't own anything else and didn't bother figuring out what the derivatives were? Probably not. And so for me, I go, Nvidia is not so expensive like an Apple is relative to its growth rate. Now, by the way, this does not mean I don't risk manage my Nvidia position. I absolutely risk manage it. So the day they report, I probably won't be in there. depending on where the stock is, obviously the stock's gone straight down into it because, inflation's high and the Fed's been raising or something. That's a totally different situation. But for me, right now, because I look at the valuation as a measure of the risk I'm taking, and I go, hey, the good news is I got a whole bunch of stocks I can short against Nvidia that claim to be AI plays where the numbers aren't going up, that I think are going to get worked over. I think Nvidia is going to have a massive beat and raise. I'd rather be with them than with one of these others where they talk about AI every time on the conference call, and then the numbers don't do anything or they go down.
Right. So you're saying you'd rather just stick with the leader at this juncture because you feel like they're reasonably priced, and
Well,
why not?
that second part's the important one, right? It's not Cisco at 135 times. Nvidia's at 40. And that's GAAP. That's not the made up, non-GAAP EPS.
Yeah, no, that's fair. And I think there may be some other potential semiconductor questions from the rest of the panel there, but I'll hit you with a follow-up question in a little bit of a different category before we go to the rest of the panel, which is in your thoughts on cloud. Now, I know, based on the Google and Microsoft and Amazon reports, there's a lot of optimism, not only around cloud acceleration, but around digital ad spending as well. So what are your thoughts on those two categories? And same question goes from what I asked before. Any specific names in either of those categories that you're looking at outside of the Mag 7, of course?
Yeah, so I think I'm really not looking outside the Mag 7 right now because I've got two very powerful things going on. One is I've got the most divisive, horrible presidential election we can all imagine coming up. And there's going to be so much money spent on social media to influence voters. It's going to be crazy. So for me, I look at that and I go, and that's going to happen regardless of the Fed's raising or cutting or the economy's in a recession or not. So why would I want to own anything other than Facebook in that scenario, especially with the pressure now on TikTok from the government? It's reasonably priced, right? It's 23 PE. The S&P's at 21 times. Meta's growing revenues at 18% this year. The S&P's at 5%. They grew revenues at 16% last year. And one of their big competitors, TikTok's under a tremendous amount of pressure, and I don't think the Chinese government will allow it to be sold. So I love that for spending. And then when it comes to the cloud stuff, I'm kind of cheating because Amazon and Meta, to be clear, were two of my top 5 picks coming into this year. Amazon more so because of their retail business and the leverage there. And if you look at Amazon from your perspective, which is the AWS piece, revenues for AWS were up, I think, 40% year over year. I think they peaked at 2021. They came down to 12%, I think, in June and September, then went up to 13% December, and then they accelerated to 17% in March. And they printed their best operating margins in AWS ever while doing that. But the real leverage is coming from the retail business. So with Amazon, you get a little bit of both things, where they printed the best operating margin in their history at over 10% versus the 8.1, I think, or 8.2%, which was the prior record back in, I think it was 2021, for a quarter. And so there you got EPS that can double year over year, and that's driven by cloud and the acceleration in AWS that we just talked about, going from 12% to 17%. And for those viewers who don't know it, they are the biggest public cloud vendor on the planet, with about a third of the market share by themselves. And so if you're thinking about, I want to test this AI thing out, that's where you kind of go to run it. You got Google and Microsoft, obviously, after that. They're also seeing business, their cloud business accelerate. Google went from, I think, 32% growth, I think, in Q4 to 34% in Q1 on the Google Cloud platform. I'm 99% sure that's right. And, so that's obviously accelerating. But Google's not an enterprise company, right? They're more of a consumer-facing company. So Now, Microsoft actually is probably the best because they're an enterprise company, and their revenues also accelerated from 28% growth in the prior quarter to 31 in the most recent quarter. And obviously, they have this great relationship with OpenAI, which we all know, ChatGPT, that's what they produce. And they only have 3% search market share, and Google has 93% search market share. And so if you believe that all the spending on AI is going to have some return, I got to believe that 93% share at Google goes down and the 3% share for search at at Microsoft, excuse me, goes up. So that's why I kind of, if I'm thinking about cloud, I go Amazon because I got the backstop of the retail business where margin expansion is huge. And I got Microsoft, and I don't like Google because my basic view is I think AI is real. I think it matters. I think there's a lot of good other companies out there like OpenAI or Anthropic or Mistral or Perplexity or you pick your favorite. And I gotta believe that 93% search is under assault, and that's their bread and butter. And that's why longer term, I think, and by longer term I mean years or a decade, that's going to be under assault for a period of time, especially as we change our habits on quote unquote searching, where instead of searching, we may just have an AI assistant that we ask a question that gives us back an answer, and we're not clicking on 10 blue links having to research something ourselves. So that's how I think about the winners or not.
I was going to throw over the panel, but I'll ask you one last follow-up since you did bring up Amazon, which happens to be a darling favorite of mine as well. One question I want to ask you on the Amazon front is, what are your thoughts on international revenue for Amazon and the idea of some additional international fronts turning profitable? I know.
Well, yeah, that's the next phase, right? Because that's been unprofitable for a while, and so that's the next
Mexico turned profitable this quarter.
That's
right?
That's the next thing, is getting that up to scale. Because the simple thing with Amazon is, like everybody else, they thought the benefits of COVID would go on for longer than they did. Then e-commerce turned lower, and they had massive overcapacity, and now they have huge incremental margins because now they're filling all that excess capacity. And I like earnings growth. I like profits. And if you look at them, they beat their operating profit forecast by 30% last quarter. 30. And so that's what I want out of my companies. And also Amazon's a little bit recession, beneficiary. I wouldn't say resistant, because no company's resistant, because they pick up share during recessions because people go price shopping. So I like that about it as well. So, and to your point, international, getting more profits out of that segment, that's a huge growth driver. Like, there's no company other than Nvidia that I can think of size where the EPS is going to double from 23 to 25 on a GAAP basis. Other than it.
Yeah, not to mention they have so many unpenetrated verticals too that they're opening up now.
Yeah, and they spend money. Like, they spend a lot on R&D. Like we talked about those numbers before, but unlike an Apple, they spend capex to revenues 12%, R&D as a percentage of revenues 14%. That's 26% added together. Apple spends 3 and 8, which is 11 added together. Like, these guys actually invest in technology, and I like that if I'm going to own a tech company.
That is fair. Okay, I appreciate those thoughts there. Monativ, I saw you had your hand up.
Yeah, hey Dan, good to see you here again. So, couple of things. I'll start off with one comment. It's not like Apple is spending cash to buy back; they are loading up debt. It's over 100 billion and increasing at a pretty nasty clip. Yeah, I get the tax benefits and all that, parking cash and not bringing it back, but it's still a scary amount of debt that they're starting to carry. So, I'll try to tie some of these together. So, corporate refresh cycle, we've been waiting for that. A lot of companies are just not seeing it. We're not seeing it in the guidance so far from the ones that have, that have reported. So Are you seeing any signs that that could come about? Because that could help, the rest of the semiconductor, or at least some of them. Certainly, AMD, for example, could pick up some, or could see less weakness in the other areas where they're not catching up on AI, right? So that was my first question, and I'll have follow up.
I mean, you said it yourself, right? We're not seeing any signs of it right now. It doesn't mean it won't happen. A lot of people hope Microsoft end of lifing their latest Windows product will help an upgrade cycle next year, but we got to get through this year. And is there an economic slowdown? Because the one thing that's come out from all of these companies on the consumer side, or not all, but a big portion of companies that reported recently, McDonald's, Starbucks, go through the list, is that there's some pressure on the consumer. So we'll see what happens, because at the end of the day, the U.S. is a consumer-led economy. And if there is pressure on the consumer, then, an upgrade to PCs or smartphones, you have to take that into account as some pressure on that. But I have my long-term forecast, but I look at the day-to-day data. And to your point, you don't see any evidence of it right now. So, and the funny thing is, if you're a bull every year, right? And we went through the Apple numbers for the last 5 years. Every year, without fail, somebody comes out and says, "Oh, there's going to be a big upgrade cycle," and there isn't. So, COVID drove one, obviously, but that was for a totally different set of reasons, because everybody had to have their phone and working from home. But since then, there's been nothing. So I'm hopeful, but right now I don't see any signs of it. And so, hope is not an investment strategy, as I like to say.
Yeah, fair point. So the follow-up question I have, a slightly different topic, but what you just mentioned, a lot of guidance is starting to be weak Q2, but keeping 24 numbers, which means they are expecting back half growth. What are they seeing in the back half growth? Obviously, they're not talking about it. That would, that would justify, well, okay, it's a little bit farther away, but besides that, are you seeing
Yeah,
anything that?
I hate companies that guide long term. I think companies just shouldn't do that, because no company has that kind of visibility. I mean, what always gets me is companies that say, "Okay, well, I'm going to guide for the next 90 days. I'm taking my numbers down." And I always joke, I go, I've never met a CEO that doesn't think 6 months from now his business isn't going to improve. Because in the near term, your business may suck, but to some degree, to be a CEO, you have to be an optimist. I mean, Elon Musk, I think, kind of said it best. Doing what he does is like chewing glass and staring into the abyss. So you've got to be an optimist to be a CEO. But I think the problem is that people go, "Oh, well, they have some special insight into, well, the near term's terrible, but like 6 months from now, so I'm going to keep my full year the same, but I'm lowering the next quarter." And so all that does is it puts added pressure on the back half of the year. And I think we've all just been talking about how things look like they're, kind of slow a little bit, at least in term.
So Dan, that's a really good point, because we've seen that all quarter. There's several, especially in the software space, seen companies downgrading Q2 and keeping estimates for the rest of the year. And when you do the math, we're now looking at a fourth quarter for S&P 500 companies with 18% growth expectations after 8% growth in the fourth quarter last year. So difficult comps. So if we just keep doing this, we keep saying, "Oh, second quarter won't be that great. Third quarter won't be that great." It pushes all your growth into the fourth quarter, which just seems unrealistic.
Absolutely. That's why I like companies like Apple that don't guide more than a quarter out. That's the way you need to do it. And by the way, Apple's had every quarter last year after they reported the forward numbers have come down. So at least they didn't have a full year estimate they had to deal with. So they've done a good job with that. So I really hate long-term forecasts, because I've been in this business long enough where, the downturns are always worse than you imagine. The upturns always go on for longer than you imagined. And the best these companies can hope for is to look out 3 months and hope they get close. And I think we've seen this often enough to realize like that's the truth. I think CEOs, for their part, I always like an aggressive CEO and a very conservative CFO, because I think that's the best combination at a company. And so, like, I hate seeing the next quarter cut and the full year maintained, because part of that is too hope on their part. Because the near term is where they have the most visibility. The longer term is where they have the least visibility. And so, like, why do that to yourself and set that bar? Because the analysts, and I did that job for a while, 99% of them, they will all just put out whatever the company says in their models. And then all that does is it increases pressure on the back half. And I go, yeah. And like, energy prices are up 10% year to date. They were up 20 at one point. Interest rates have gone up. We're talking higher for longer. And stimulus, benefits that used to be in people's savings accounts, those are running out, especially at the mid to low end consumer. Like, you have all of this stuff going on. So why on earth would you leave the full year the same if you have to cut near-term numbers? Which is why when I started the year, my forecast had been, yeah, I could see the stock market up 20% in the first half of the year, but I could also see it going down 30% in the back half if some of this other stuff, comes to fruition. And so I manage the portfolio. I manage, my positions day by day, and, try to balance the risk versus reward. And what I've seen this week on the consumer side definitely makes me nervous. And quite honestly, the guidance for June from the big caps that we just talked about, where numbers didn't go up, despite AI.
Dan, you did talk about Elon Musk there for a second. Hey, we're on Twitter for like 45 minutes here, and no one talked about Tesla. That's probably a record, but really good. But we'd love to hear your general.
The media talks enough about Tesla every 30 minutes,
Well, I mean, I'm a massive Elon Musk fan. I view him, and I've said this before on your podcast, like, I view him as the Thomas Edison of our generation. Like, you think of a man who's changed so many industries by his sheer force of will, whether it's solar or space exploration, or even what he's doing for, transportation with his tunnels. Like, he's just incredible. But when I look at Tesla, Warren Buffett has a saying, when a great manager, or I'm going to paraphrase this, I'm going to butcher it, but when a great manager meets a bad business, the business will keep its reputation intact. And for right now, the EV business, for whatever reason, demand for electric vehicles is slowing down. You've got tremendous competition coming from the Chinese. And financing costs for automobiles have gone way up, along with interest rates. And unfortunately, Tesla's got an ADPE. So you put that together, and despite the fact that Elon's probably the most brilliant guy on the planet, it's going to be a tough road. And people care now. They didn't care last year. As I said, estimates went down 50%, 50 last year for the fourth quarter that they reported. And the stock was up 100. But that can't go on forever. And obviously that's turned this year, where estimates have kept going down and the stock's now down 30. And with an ADPE, it's just hard, as much as I want to be bullish on Tesla.
Have you tried full self-driving or FSD supervised or whatever it is before? And do you have any thoughts on that one? When the bulls talk about Tesla, that's I'd say the
by the way,
normal
I have the the big, I don't have the Cybertruck, but I don't have the Cybertruck, but the Tesla truck before, or not the S.
the
truck.
Y.
The Y, yes. Sorry, I keep forgetting the letter here. My kids always make fun of me for that. But yes, I have the Y with the the funky doors, which I love, which reminds me of
the X.
Yeah. So anyway, but yeah. So I've checked it out. Like, I'm a control freak, so I hate having my hands hover over the wheel while it does its thing. But my son, who's in his 20s, when he takes it out, he loves it. Like he uses it with full self, with the full self-driving. He thinks it's great. Like for me, I like having control of my car, so I'm probably the wrong person to ask. But I love my Tesla. I think it's the best. It's a computer on wheels. Like it's a marvel of engineering. So yeah, I mean, now the problem here, this is a different issue, which is it's really unfortunate that because Tesla isn't unionized, that but to be fair, the government is suing every big cap tech company for one thing or the other. And so, to me, I view America as the greatest, country on the planet. I'm not from here. I immigrated here. I'm a U.S. citizen now. And so the opportunities here are unbelievable. And it just saddens me that we're not supporting our companies against the rest of the world, because the Chinese are sure supporting their companies against the rest of the world. And Tesla has the best technology on the planet, regardless of whether they have a union or not. But they're constantly under pressure from the government. But to be fair, the government's after every one of our big tech companies. So I guess they're playing fair by hating every one of them.
I was on mute, but that got me a little chuckle there. I got one more question on my end of the plant stuff, and then if anyone else has any things, I know we like to go in about an hour here, and we got about 10 minutes left within that, but we're going to stay as live as possible. I want to hear your favorite Mag 7 pairs trade. There's one name. I guess it could be two longs or two shorts, but preferably one name that you think that would go long or one short, and honestly, whatever time frame you want. Could be year, could be 5, could be 6 months, whichever one you want to throw from that front.
Yeah, I think we already talked about it to some degree. Like Google over the long term, if you believe in AI, they have 93% share in search. That's their bread and butter. So from a longer term basis, now obviously they're going to benefit from the election spending too. But that's the one over a longer term basis. They have to cannibalize themselves, but everybody else is trying to cannibalize them too. And then I look at Meta and I go, reasonably priced, good, revenue growth. They're going to benefit from the elections. TikTok is, I don't think, going to be here. I think from a longer term perspective, that sounds pretty good to me.
It feels like Meta is also one of those companies who could encroach in Google's search area. I don't know have you seen the Meta AI thing that they've added into different areas?
Yeah, and that takes away from Google's search revenues. The other thing too, which we haven't talked about, is I really wonder if the Ray-Ban, Meta Ray-Bans, that becomes the surprise winner in this whole. The Vision Pro, I think, is a joke at $3,500 for the average consumer. But I go at $300 for a Ray-Ban $350. Could that be the surprise sleeper hit when they go through their next round of changes and add some AI features to it and such? And so, we'll see. I live in Florida now and I don't speak Spanish. And so it'd be great to have a pair of glasses that automatically, change the menus on the fly and gave it to me in English and help do auto translations or whatever, right? And if you can get it to me for something that doesn't, nobody's wearing a Vision Pro out on the street. You can wear your Ray-Bans out on the street, right? Nobody talks about it. I get why, but I do wonder, 2 years from now, could you put a little more features into it at a price point that the average person that can afford, that's not dorky looking? And we talked about how much Meta is spending. They're spending 19% of their revenues in CapEx. They're spending 26% of their revenues in R&D. That's 44% combined. Unless you think every engineer they hired is stupid, there's probably some return on that at some point, and it may not be today or tomorrow, but a couple of years from now. I think Zuckerberg is pretty smart. We'll see what happens. And I'm not paying a lot to get it at 23 times. And by the way, if something goes wrong, like we saw in 2022 when he said he was going to spend, an exorbitant amount on the metaverse and the stock got hammered, and then he changed. And he came back and said 2 weeks later, no, I'm going to spend less. that gives you a margin of safety because you can always decide I'm going to spend less than what I'm currently spending if there's an issue, which, a company like Apple doesn't have that luxury. They're already spending very little. Like, how much more can they cut it? So that's probably the pair that I'd kind of think about in my head from a longer-ish time basis. The one thing that keeps me up at night on Meta is obviously, they've got, if you exclude China, which they can't get access to, they've already got a good portion of the world using their products. Like, at some point, you just run out of people on the planet you can add. So at what point does that become an issue?
It's like 50% or something like that of the world's population uses a Meta product on a monthly basis, I think it was, or even daily.
Yeah. And so that's my point, where you go like, there's multiple ways to grow, but that's one of them, right? You add more people. The other one is you have each of those people paying more for what they're using. And, and then the last piece is you have them spending more time on your stuff. So that's one of the three things. And so eventually you run out of people on the planet that you can get to, right? So I don't know where that is, but like, that's the one thing with Meta that I kind of sit there and think about and go, like, when does that become a problem? Because it sure doesn't seem like a problem right now, which is pretty amazing when you think about it.
It's pretty hard to pitch the idea that Meta is in their first half of acquiring users. It is still in the first half of acquiring users rapidly for the long term. It'll take a couple decades, couple centuries for that one to come about. I find the Ray-Bans to be very, very interesting. Less for what they are right now, but because that's, in my mind, the form factor for if the metaverse or if AR, which is what market now accepts, that's what it needs to be. I'm one of those believers who actually believes the Vision Pro and the Meta Quest will be competing in a big new space going forward. I probably think it's in that 3 to 5 year range, just given how hardware has developed over the last couple years and couple decades. It might be closer to that 5 year one, because those headsets are bulky. Apple's batteries are literally on the outside. That's horrible. So there's a lot of rough things about it now, but the Ray-Ban glasses, I think, are the complete other end of it, where they have the perfect form factor, but not enough features yet.
Yeah, well, and it's always a combination of the two, right? Like, do you need a Ferrari to get you from point A to point B? Not really. And so for me, my kids will call me cheap, but I like to think of myself as frugal to some degree, and this fits a nice price point, right? Not everybody in the world can afford a Ferrari, but a lot more people can afford a Toyota. So I kind of look at these Ray-Bans in kind of the same vein. Like, at $3,500 for Vision Pro, that's a totally different price band than $350, which is still not cheap, obviously, but it puts you into a totally different category of people who can at least check it out and see if it works. And they look actually pretty good too, right? So you can wear them out in public and nobody will look at you funny. So and you're right, the time frame on this stuff. Unfortunately, I'm a technology optimist, and so I always think things are coming sooner than they will, and that's probably the case with this. But let's face it, AI has made unbelievable strides in just the 15 months since we heard of ChatGPT. So we'll wait and see.
Let's go over to Stock Talk for the last question on this.
Well, on that point you just made about the strides that have been made in 15 months, first of all, I agree with you. But one criticism you hear pretty often is that you haven't seen the earnings power permeate through the industry the way people expected it to. And I personally find that to be a hasty criticism. I think, in the next 10 years, we're going to see a lot more, not only productivity as a result of this, but earnings power as well. So what do you kind of see as the next frontier? I mean, we talked about semis earlier. We talked about the idea of, GPUs continuing to be a pretty high demand business and will likely be for the foreseeable future. Where do you see the next big shelf of earnings power rising in this theme, if at all? And I know I'm asking to speculate there, but I'm curious.
I think where the next thing will be is which companies actually harness this thing well. Meta has done a great job, right? They're showing you the videos that you want to see. They're surfacing those, so you're spending more time on the platform, and then they're using AI to help optimize the amount of dollars they get for every ad that's shown. So the question is going to be, out of all of these other services that sit on top of AI, who's going to do a really great job? And I honestly, I haven't found somebody yet, and I'm looking. Like, there's a lot of stuff that's interesting, but for me right now, much like you started the thing, there's all this optimism, but like, where have the numbers really changed? Really nowhere. And so, if you want to be, and I'm not a pessimist on this, and this is not what I believe, but there's also the school of thought. You go, well, this is just table stakes, right? Everybody's going to need to have some AI capabilities. Everybody's going to spend a bunch of money, and it's just going to, in the near term, it's going to bring down profitability across the space because of that, and then it'll monetize. And the truth is somewhere probably in between. So, I mean, we just talked about Meta. Could like the Meta spectacles be, glasses be, Ray-Bans be like kind of the next big thing? I haven't really seen something where I go, yeah, this company is really going to use AI well. We've already talked about the Mag 7. So outside of that, like, there's not one name that I go, oh yeah, this is the one. I'm quite honestly, like, if I'm looking at derivatives, I'm looking at kind of like power. Like, one of the top picks coming to this year and was the uranium, ETF, and you're hearing more and more about nuclear, because, and the thing that's obviously getting brought up now is you can get the chips now. The problem is now getting the power to these things. So that's kind of where I'm sort of looking. And it's not sexy, obviously, but like, if I think about it and I go, okay, these things are power hogs, like, maybe that's a good place to go look. But at some point you will come up with some company. It's just, I honestly, I haven't found something that I go, yeah, this is the one. Because quite a lot of the software names that have said we're AI centric, and I'm going to not name names here, but I think you guys all can pick your favorite. They all talk AI, and then they report, and the guidance goes down, and people are like, wait a minute, you said you were an AI company, and then why are your numbers getting cut? That's the problem you're running into it with pretty much all of them right now.
Awesome, Dan. I appreciate you joining us on this Spaces. I really do. We're lucky to be able to hear from you it feels like every quarter or so. So I appreciate you for joining in. Just quickly before, I just want to make sure everyone down below, if you enjoyed the Spaces, make sure you're following Dan. There's a lot of really great information shared on here. The recording will be available after this is done, and we're going to clip some stuff up. So there's a lot more of this will be seen, will be easy to view. And also, I pinned up in the nest above Dan's new website. Congratulations on finally owning everything you're doing. That's a really great feeling. So, and it's so recent. So, congrats for that, and we appreciate you. And I want to know if there's anything you want to leave people with, any final comments, anything like that.
Stay nimble, stay adaptable. Don't have any fixed thoughts in your head, because I think you're going to need it in the back half of this year. But that also, volatility creates opportunity. So best of luck to all of you in your investing. It should be a fun back half.
Sounds like we have a good Spaces or two coming in front of us talking about that half.
Awesome. All right. Take care, everybody.
Appreciate you, Dan.
Thanks for having me on, Evan. Bye.
Have a great one. Awesome. That was a fantastic conversation there, capping off a pretty big day of earnings.